Yo, what's up everyone? It's your boy Looney, and today I'm breaking down why I'm still selling options or selling puts right now in 2025. I'm going to show you exactly how I'm choosing my strike prices, what I'm targeting, and why this strategy still works even with all the noise we've been seeing. Quick shout out to the Discord. It is free to join, and if you want real-time trade alerts, one-on-one coaching, or my full options selling course, that's in the premium. It's only $8 a month. Links are in the description. Let's jump into it. So we're halfway through 2025 and the market is in a weird place. So some names were a little overbought. The market struggled in the beginning and now we are seeing that it is cooling down, and still some positions are still bleeding from 2024 or early 2025. And volatility is going up, it's going down. We're kind of all over the place. And we're seeing these headlines with more geopolitical noise and attacks. We're seeing some crypto pump as well. But this still tells me one thing. Premiums are still worth selling if you're strategic about these news. So why am I selling puts right now? And it's because I want to buy shares, but at my price. Selling cash secured puts lets me collect income weekly or monthly, and you set your own entry points. It's essentially a limit buy, but you're getting paid to set this trade up. And number three, it allows me to stay patient instead of chasing breakouts. So let's just kind of analyze some of my cash secured puts I have set up. And most of them are in Mara. You could still do this with SoFi and other stocks. The reason I'm choosing Mara is because of my own average cost basis, not because of the company itself, even though I do believe that this stock is undervalued. I'm more doing this just because of my average cost. I'm trying to get it down. And let's say I want to own Mara, right? But I don't want to own it at this level, at this $15 level. I can sell a put below this price, and that's exactly what I'm doing. So I have a $14 put and $12.5 put and a few others, basically lower than the cost it is today. If the stock does drop below these levels, I get assigned, or you're forced to buy these shares at that level. You could close early, but I usually don't do that when selling puts because you usually realize a loss. But if you get assigned, there's still a chance that you can make money because you're essentially buying low. And some people might think, why not just wait for Mara to drop to these levels? And I wish I knew whether Mara was going to drop or not. And if I did, I probably wouldn't be buying or selling a put. I'd probably be buying puts or betting that the stock is going to go down. Whereas selling a put, it takes the emotions out, and you're essentially just saying, I'm okay with owning this stock at that level. So, and you're getting paid to do it. You're getting paid that premium. So if we go to my $14 put, which is actually one that might get assigned depending on where the market opens, I'm still getting paid. I got paid $71 and it was a month trade. So I did this about a month ago, and essentially I'm getting paid this $71 just to do a limit buy at $14, and I'm waiting a month for that to happen. So it's a perfect setup. And I'm still doing these on other names like Riot, and I do plan to do it on SoFi, but not right now. I still want to get my shares acquired, my average cost down on Mara and other stocks, and I will begin to do it on SoFi. And SoFi itself kind of needs some cooling off. Even though it did drop 5% due to the recent attacks or the headlines, I still believe that there's some time that needs to go by. We need to see where this stock actually trades at. And also with this strategy, you could layer it. You can do dollar cost averaging. You could choose different strike prices. So I'm not going all in. I set up a $14 strike price, and then the stock ended up dropping. And to help with this, I sold another put at a lower strike price, that 12.5 or that 13.5, and I continually did that as the stock dropped. And that's a good way to DCA at good levels, at lower levels. And that's exactly what I'm doing with Mara. And I still have other cash on the side, so I'm okay to deploy if I see different opportunities, whether in that stock or a different stock. So how do I choose my strike prices? What am I looking for when setting up these sell puts? Well, one is I always choose out of the money. And when selling puts out of the money just means that the stock or the strike price is below the current cost. So anything below this line, below the 15.11, is considered out of the money. And that's what you want to be doing when you're selling puts. Now, with that, I usually look at deltas. So I usually go for a 15 to 30 delta. Mara is a pretty volatile stock. So if I click on one of these on this, I say 20 we could look at real quick. The IV is pretty high, 76%, and this one's 67%. They're all around that same amount, that's 70% or 75%. And so because the stock is very volatile, I usually choose lower deltas. So I go below the $30 delta. And you might be thinking, well, that's that $14 put, that has a higher delta. And that's because I did this trade earlier than the others. And at the time it was at a lower delta. And now that the stock has dropped, this delta on this $14 put has increased. And to combat that, I set up trades that are lower. And that's why you need to have cash on the side. You need to be prepared for lower dips and not go all in. But I have realized that 15 to 30 delta is a sweet spot where you get solid premium without taking on unnecessary risk. I am aware that some people do strategy where they go in the money selling puts. Now, you can do that. It's just it's not for everyone. It's a very risky strategy, and that's not what I like to do. I like to have a very calm and easy strategy that is replicable. And that's exactly what I do. So 15 to 30 delta below the current stock price. And also I like to go 1 to 6 weeks out. I have been doing more monthly, and that's because the manage is a lot less when you go further out. There is no true benefit of going shorter term to longer term. They're all very similar, but that 1 to 6 weeks is the sweet spot when selling puts. Now, am I checking the charts? Is that important? Yes, but you could sell puts whenever. If I'm being completely honest, you have to just make sure your risk allocation. So if I'm selling puts when the stock is high, I try not to do a lot of contracts. And then as the stock drops and gets closer to the lower Bollinger Band, I tend to do a little bit more contracts and get more positions involved. So I do look at if it's near support, if it's oversold. So that's why I have the RSI. And we can see here, it's getting close to that oversold point. Oversold is usually around that 30 level or below that 30 level. And also I do look at the Bollinger Band. It's not everything. I do have my notifications set up so that it kind of tells me if the stock goes below the Bollinger Band on a 1 hour interval. And that's usually when it's a good time to sell more puts. But that doesn't mean I don't sell puts all the time, because I really do. I do sell puts almost all the time, no matter where the stock is. I just like to go a lot less positions when the stock is trading higher. So I'm also looking at the stocks I already own. If I'm already overweight, so Mara only takes up 8% of my portfolio, but if it takes up 40%, I probably won't be selling more puts, probably just sit back and acquire shares from other positions, because you don't want to be over leveraged or just over compensated with your allocation. So that's why I do pay attention to that, and I won't go heavy on new puts. And also, if the premiums aren't just worth it, I don't force trades. Sometimes I do just kind of sit on the sideline, even if I do want to acquire more shares, and just leave cash. I also don't know what the market open is going to be like. We could see a massive drop because of the headlines and the attacks that happened after hours, but I'm very curious to see where this goes. And also, it might seem like a very risky trade because the max loss, if I were to open up a trade, it does say unlimited, which is technically true. You can lose unlimited amount of money. The max loss on this one is $12.51. And technically you can lose $12.51, But for that to happen, you need the stock to go to zero, which is very unlikely. That doesn't mean it won't happen, but for it to go down to zero is very unlikely. Now, you can lose a lot. You can lose like $200, but if you get a sign, you could just sell covered calls and make that money back. So that's what I like to do. And that's how I stay consistent. If I get assigned, I just pivot to covered calls and start the wheel strategy. So it's all about long-term systems. So whether the market goes down or up, I'm getting paid to just wait. I'm getting consistent income. And that's why I'm selling more puts in 2025. If you want to see how I manage these trades in real time or help setting up your own strategy, hop in the Discord, like, comment, subscribe, and let's keep building. Peace.